time. Busy, no, it's tough time. That's more important because so many challenges. Many tools are not working, which was supposed to work.
Correct.
New technology is coming, which is also throwing a lot of challenges. So yeah, it's a tough time for central bank. It's a tough time for commercial banks also because they also have to cope with those new things which is coming. So yeah, it's not a and some things are changing drastically. Like you think of people have started thinking that there can be no branches in
Yeah.
commercial, which is absolutely not thinkable when we studied economics. So many things are changing which we have not thought about.
Actually, I think we
Just moving.
can start. Dr. Madhuri, can we start?
Yes, we can.
We can, yes. So,
good afternoon.
Nikita, I would
Yes,
be
ma'am.
starting and then you can come in, right?
Sure, ma'am, sure.
Yeah. So, Dr. Chiragra Chakrabarty, our special guest speaker for the session, our director, Dr. Madhvi, our faculty colleagues. I have some of my faculty colleagues also joining. Really happy to have them here. And of course, my dear students who we are discussing monetary policy in our classes these days, and this couldn't have happened at a more relevant time, right? So I really offer very warm welcome to all of you. And this is actually the first Sambhashanam session for the Center of General Management, Center of Excellence for General Management at SIBM Bengaluru. And this center essentially has under its scope the areas of economics and analytics as of now. And together we strive to provide a very strong foundation to our MBA students in their first year before they go on to specialize in their respective domains, what they choose to. And a very important part that we have realized over time of having this a strong general management foundation is not just the curricula, which is industry relevant or contemporary in nature. We also would like to bring in a lot of real world wisdom. So we would like to bring in practicing experts, and that is why our director, Dr. Madhvi Sethi, she has launched this very, very unique and a very, very important, critically, an intervention that happens at the right time for students, by the name of Sambhashanam. So through this initiative, we would be inviting real world experts, eminent experts in their own areas, and they would be offering us insights and helping the students develop their perspectives about various issues, which is so important once they step out into the real corporate world. And since it is a dynamic world we are living in, we no longer can restrict ourselves to the world of textbooks. So this initiative is basically incorporating real world wisdom, real world practicing experts, their insights into our curricula actually. And we are very happy to welcome Dr. Chiragra, and I would also request Dr. Madhvi Sethi, our director, to say a few words here.
Thank you, Dr. Vandita, for giving us the background on the Center of Excellence. And I'm delighted that the first lecture which we got is of an eminent personality like Dr. Chakrabarty. So thank you for introducing the SIBM community to him. Dr. Chakrabarty, I would like to welcome you to SIBM Bengaluru. And if we were having a physical event, it would have been great to host you here. But unfortunately, everything is virtual and we are meeting virtually. That's why. But I'm assuring you, sir, that with all that has happened over a period of time, our students and faculty have rose up to the challenge of virtual experience and have very nicely come up with events which could be hosted online. And in that series of initiatives, we thought that the students should be exposed to personalities like you who could add to what their learning is. And that is the reason that we thought that this will be a great opportunity to meet you and learn from you things which are going on in the world of banking and finance. So what I also feel is the topic which you have chosen is very apt, especially when the governments across the globe are thinking of introducing digital currencies, and we are all going through a drastic shift in the way we think about currencies. This lecture will be of immense help. So thank you so much for accepting our invitation and coming here, giving time to our students. Thank you so much. Dr. Dhar, over to you.
Yes, thank you so much, Dr. Madhvi, for that very warm welcome. And we would like to take our session ahead now. And for that, I would request the Economics Club of SIBM Bengaluru GeoCon to please proceed with the introduction.
Yes, ma'am. Good afternoon, everyone. Here we officially announce the beginning of our event, Sambhashanam. Sambhashanam is a Sanskrit word for dialogue. It is the flagship leadership series initiated by SIBM Bengaluru and is organized by the Centers of Excellence at SIBM Bengaluru in collaboration with various student clubs. Presently, we have Centers of Excellence in 5 areas, and those are finance, marketing, human resource, operations, and general management. Today's interaction is organized by the COE in General Management in association with GeoCon, the Geopolitical and Economics Club at SIBM Bengaluru, which aims at creating awareness about significant events taking place in the contemporary world. In the first part of these sessions, students will get the opportunity to interact with policymakers and industry experts. The second part of the series involves a one-on-one interview with the speaker by one of our faculty members. The speakers share their insights on individual, organizational, social leadership, and pertinent issues leaders and policymakers face in a dynamic business landscape. SIBM Bengaluru develops its knowledge quotient through this leadership series and facilitates effective collaboration between industry and academia. Now, Harish will introduce us to our speaker today. Over to you, Harish.
Thank you, Nikita. It gives us immense pleasure to introduce our esteemed guest for the session, Dr. Chiragra Chakrabarty. A PhD in economics, Dr. Chakrabarty carries a rich experience of over 26 years in prestigious organizations such as Deloitte, PwC, CRISIL, and Nomura. His broad spectrum of expertise spans the area of business strategy, financial and commodity markets, risk, valuation, treasury management, monetary policy, and digital currencies. He has extensively worked in diverse regions across the world, such as Southeast Asia, Africa, Middle East, and India, where through his valuable experience, he has helped set up and strengthen financial and commodity markets. A few among his numerous professional achievements are the development of Bourse Africa Limited, a pan-African commodity and currency derivative exchange, a member of the Reserve Bank of India Committee to set up NDS, a technology platform for trading bonds, and a subject matter expert to Asian Development Bank, providing critical inputs for its secondary debt market development. He has been a member of several technical and standing committees constituted by the Government of India and other financial sector regulatory agencies. He is the founder CEO of Catic Consulting Limited, a fintech company, and associate partner at True North Partners LLP, UK. He is also an advisor to the Governor of Bank of Mauritius and has recently been selected as expert in financial market and reserve management by the International Monetary Fund. Apart from all this achievement, Dr. Chiragra has authored 3 books related to financial markets and published in renowned journals and periodicals. Today, he is going to share his insights on contemporary challenges faced by central banks and the emergence of central bank digital currencies. Now, I would request you, sir, to take this session forward.
Good afternoon, everyone. And thank you, Harish and Nikita, for this introduction. Thank you, Dr. Madhvi, State Director, for inviting me. And thank you, Dr. Dhar, or I should call you Vandita or Professor Vandita, I don't know, because I know Vandita from a long time. So thank you very much for this introduction and thank you for inviting me. I think the thing which you are doing,
You
that
can give the
the
sharing
amalgam,
rights to Dr. Chakrabarty, Geocon team members.
Yes, ma'am.
so this concept
Amisha,
of,
Yes,
is it,
you were
am I
saying
there?
something, Chirag.
Yes, I was saying that this concept of linking academic world with the real world or the corporate world is an excellent concept. I think most of the academic universities should do this, because as I was telling you before this session, Vanita, that things are changing drastically, and it is very difficult to capture everything in classroom. It is very
Yes.
difficult to capture everything in a textbook. So you need to have discussions with the corporate world. So that, so this always helps. This type of things always helps. So with that background, let me share my screen. So which is the topic I want to talk about today for next whatever time I've been given. So can you see my screen?
Yes, yes, we can see it.
Okay. So yeah, so the topic is contemporary challenges faced by central banks and emergence of central bank digital currencies. So we will be talking about the challenges of central bank, because that's the main focus, and also we'll be talking about how central bank digital currencies is in either helping central bank or not, that we will see in the course of time. But the topic is very apt at this point of time, because when European Central Bank, Fed, and all, even recently Reserve Bank, they had to take a very tough decisions with the latest monetary policies. So because various things which was thought in the traditional monetary policies, sometimes it's not working in that manner. So that's why the central banks have to come with new tools, new technology, new thought, and we'll try to talk on those things before. This is just an introduction, one slide on Catic Consulting, what all things we do. I will not waste your much time, but it is basically we are fintech as well as consulting firm. We work on various side of risk, banking, and corporate advisory, plus technical advisory, and with the technology part, mainly focusing on the risk policies and now the fintech with the digital currencies part. That's the Catic Consultancy all about. This I'll skip because I have been given a very nice introduction by your students, so I'll not waste your time. Let's come to this topic, which is, oops. Let's come to this part, which is you're talking about central bank and challenges. And since we're talking about central bank challenges, we should understand there are the main four functions which central banks do. One is the monetary stability, which is the main focus. So monetary stability comes from the monetary policy transmissions, and which comes from monetary policy, in fact. So one pillar is monetary stability, to bring stability in the monetary or financial sector or in the entire economy. Then another thing comes the financial stability and regulations. Then another one. So one is the policy channel through which we design the policies. Another one is the regulation channel through which we design the regulations for the stability of financial industry or finance industry. So financial stability is another factors, another pillar which the central bank always looks upon. Third one, which is the financial infrastructure provision. So this is the another major area where central banks are working in a big way, where a lot of fintech things comes into the picture. So financial infrastructure provisions are basically the payment system gateways, the clearing of the entire economy, and so on and so forth. That's the third segment or third sector of central bank, which is the central bank focuses on. And the fourth one is the central banking operations, which is basically through operations, we mean financial market development, financial market regulation, financial open market operations. All these things is done through that. And when you talk about these four pillars, monetary stability, financial stability, financial infrastructure provision, and central bank operation, all these four pillars are, if I can use the word, highly correlated. It cannot go, it's not isolated. So each and every function works in one with the help of another one. So if you are doing anything related to monetary policy, when the policy is decided, this policy part gets implemented through the central banking operations. So when you talk about monetary policy, you will see that many things which is we talk about open market operations, it is done by this pillar because the policy is done, but then this is done by them. When you talk about digital currencies coming into picture, it may be part of the monetary policy or financial stability policy, but it will be done by this pillar as an implementation part. So both this, we'll see a policy segment here, a regulation segment here, and implementation segments are this part. So these are the four areas of central bank where they have to deal every day with the challenges, new challenges which is coming to them. So but I just wanted to start with this so that we are on the same page that all central banks are doing these four things: monetary stability, financial stability, central banking operation, and financial infrastructure provisions. Other than this, they don't do much work. So these are the four areas which they are looking for. And you'll see this areas leads to various things like continuity of critical functions. If they don't provide a proper backup for technology backup for commercial banks, financial clearing, then the bank will, or commercial banks will not work properly. So the payment system becomes very important part there. If they don't develop markets properly, then you will not have a bond market, and if you don't have a bond market, it will be very difficult for having the equity markets and other market, because that the interest rates plays a major role in valuing those assets. So the asset valuations base comes from this type of market developments. And obviously, financial stability is one of the key area now. If we don't have a proper financial stability, nothing will work, because if you don't have financial stability, you will not have investments coming to your country. There'll be a lot of uncertainty. Risk will be on the higher side. A rating will go down. So many things we can talk about. So financial stability is very important. And obviously, the final one is monetary stability. That is, through monetary policy, we try to do this monetary stability part. So that's the starting part I just thought I'll do. But our main focus is the global crisis. So this is the other earlier slide where the central bank does in the normal time. These are the things which they'll do. But when you talk about crisis, which is not a normal time, it's purely an abnormal time. We have central bankers have to behave in a different way. So if you see the two global crises which you've seen very quickly in quick succession, one was the GFC of 2008, where we have seen a lot of problems, which is leading to repercussions of entire economic crisis coming from the financial sector. And we have seen something of COVID-19, which is started from 2019, and we've seen that how it has become a major problem. And still we are into that crisis. Because 2008 crisis we were just coming out of it, and then the COVID thing came into picture. So that's why I just thought that it is better that we should know that through this global crisis has really bring a lot of stress to the financial sector as an economy as a whole. So once this things comes, obviously the central banks has to behave in a different manner. And what are the common things which is we have seen that common factors of this crisis, where one of definitely common factor which we have seen now, which has become more stronger compared to 2008, is that all international authorities responded to this crisis in a very quick manner compared to GFC. In COVID-19, we have seen all the international authorities coming together very quickly. Fiscal authorities like governments and other things, they have been across the globe doing the same thing. Like for COVID was increased spending, including providing much more generous unemployment benefits. So it was basically an fiscal was expenditures or on the higher side, and that was obviously required at that point of time. Central banks made it more widely available in financial markets and supported markets for illiquid securities. That's again one of the things which is very common, which you've seen that in 2008 as well as We have seen that in COVID-19 cases now. Regulators allowed banks to reduce their capital and liquidity buffers and encouraged lenders to work with borrowers. So whatever required to ease the credit part was done, and across the globe it was done. In 2008, it was done in a little lagged manner, but in COVID-19 situation, it was done very promptly by all the central banks. And that's one of the differentiator between these two crises. In GFC, if you see, initially all central banks thought that our country is not affected by GFC. It is the problem of United States and United Kingdom. But slowly we saw the repercussions, slowly we saw the linkages coming in, and it became a global crisis. But in 2020 crisis, which is the COVID crisis, we have seen that it was global from the first day. In 2-3 months, we have seen this has become a global crisis, and it has really killed the economies in badly. So common factors were there that this, and the behavior of the central banks were also very common, that they came together to sort out these issues very quickly. But obviously, all the central banks or the fiscal authority, they had only 3 things or 3 tools to work on: the monetary policy, the fiscal policy, and the financial policy. Because other than these 3, you don't have any other tool to do, to do crisis management. Crisis management can be done by these 3 methodologies, these 3 tools. Now, what are these 3 tools, which I was just thinking, because as I was told that you have people from different subjects, I was just thinking that we should talk about a little bit on a basic of monetary policy, and before going to the what all things has been done for COVID across the globe. And I just thought I'll touch upon this because I've seen, whenever talking to students who are not from economics background, and generally the economists, they try to use word which is not very user friendly to the non-economic students, like accommodative policies and blah blah. What is monetary policies and all these things? So I just thought that it's better to have so that we are on the same page. I just wanted to share a few slides on this. So obviously, monetary policy, as we all know, is central banks think that by adjusting money supply, because that's a major tool of central bank, and they can speed up the economy or slow down the economy. That's the main factor, because through money supply you can capture the inflation part. But there's a lot of theories also that talk about if inflation is not a monetary phenomena or more a fiscal phenomena, and there are a lot of debates on this. So I'm not going into those debates at this moment. But the monetary policy's basic is that they assume that if I can control money supply by certain tools and techniques, then I can speed up the economy or I can slow down the economy, depending on the scenario. So to get economy out of the recession, central bank encourages people to spend more. To stop inflation, central bank discourages people to spend more. So these are the 2 basic things of the monetary policy which we look into it. That and again, central banks, what they have 3 tools to play around. One is the reserve requirement. Second is the discount rate. They play around with the discount rate. And third is the open market operation. So what's the reserve requirement is? Reserve requirement is the, like CRR and SLR in India. SLR is not there in many countries, but CRR is common in all countries. That is the cash reserve ratio. And which is like basically most of the central bank, based on their time deposit and aggregate deposit, they have to give a certain amount of reserves with the central bank, because as you know, central bank is the lender of last resort. So in case of problem, that reserves can be utilized to help the bank to come back to operation, or at least to give the depositors money back. So reserve requirement is one thing. That's the requirement. But what monetary policy does is that they either increase reserve requirement or decrease reserve requirement. So when they do that, when they increase or decrease reserve requirement, what happens? It impacts the money supply. How it impacts the money supply? Basically, if you increase the reserve requirement, that means that it will cut down in the money supply, because that much money will be sucked into the system. If you reduce reserve requirement, then the money supply will go up. So that is one tool which central bank always use for controlling money supply. Discount rates can be many. In some banks, it is bank rate. countries it is the Fed rate, some countries this is the repo rate, some countries it is reverse repo rate, in some countries it is repo rate minus reverse repo rate, the spread rate. So that's the rate at which central bank will be lending to the economy. So that is another interest rate to which you can, fine tune the monetary policy depending on the recession or inflationary period. And the third one is open market operation, which regularly central bank does, is that they either buy government bonds from the market or they buy foreign exchange from the market. Both can be open market operations. So don't get confused. It is they buy government securities from the market and then they inject money supply into the system, or they buy a dollar from the market and they sell rupee into the system. So this is the way they inject money supply. If they want to reduce money supply, they just do the reverse. They issue governments, they sell, not issue. I should not use the word issue because issuance of government securities done by government. Central banks are just the investment manager or for the government. So so if they want to do the reverse part, what they do, they sell government securities and mop up the liquidity, or they sell dollar and mop up the local currency. So these are the three things which the central bank have. And in this various permutation and combination of these three things are used in the real world to do monetary policies. Can you think of any other tool? Basically it's a combination of these three tools which is used for monetary policy in different way with a different name, and we'll talk about that in this slide. So if you are looking for a monetary policy on this, so you will see that basically increase money supply, so decrease is a requirement, I just talked about it, or decrease the discount rate, or buy bonds, that's open market operation, and it's called easy money policy or easy monetary policy. Or if you want to do the other way around for inflation, so you decrease spending and money supply, increases of requirement, increase the discount rate, or sell bonds. So that's a tight money policy. So these are the two things through which we play around in various permutation and combination. And third one is fiscal policies, which you have also, which is because it is very interesting now, I must say that again, I would not go into the debate, but there is a lot of nexus which has happened between monetary and fiscal policies across the globe during COVID time. And when I say nexus, means I'm not saying the central banks are no more independent from that perspective. They are independent, but what they have done to look into this or to sort out this big global crisis, the government and central bank has worked together and it's not only India, not only US, but even small countries like Mauritius and other things. They have seen that we need to work together in this fiscal and monetary policy. And to some extent that's helping them without losing the independence of the central bank. Central banks are still independent and autonomous, but when it comes to sorting out the credit crisis, they have come together and worked together. So in terms of fiscal policies, we have expansionary fiscal policies where you increases economic growth, higher spending, tax, and contractionary policies, the reverse of it. So that gives you a little bit of background on the basic stuff. And then we move to the major problem of the crisis of COVID. The first part is all known to everybody, that we have had COVID since 2019 and countries began implementing travel restrictions and blah, blah. So those things we know. But what is a financial crisis, basically? If you want to understand that, what is financial crisis? The financial crisis is the period in which the stability of the economic system are threatened through asset price volatility and disrupted financial activity. So these are the two key things which we always should understand, that if I have my asset, an asset can be equity, bond, currency, all the market assets plus the real estate asset and so prices. So if you see the financial crisis, we have always seen that whenever the asset price volatility goes out of the range, because each and every market, they have their normal volatility and they have their abnormal volatility, which we know that, and it differs from market to market. Government securities market, asset volatility will be very low, whereas equity will be pretty high. But if you go to commodities, it is much higher. If you go to Bitcoins, it's further high. So they have a different volatility. And when they are out of that volatility, and we generally see that then that's a problem which is happening in this market. So asset price volatility is one of the indicator of financial crisis, which may lead to disruption in financial activity. So defaults and so on and so forth can come into picture. So financial crises are periods in which the stability of the ecosystem is not there. And that's why reason why all the central banks are very scared of financial crisis, because the financial stability goes for a toss. And if financial stability goes for a toss, that in their economy have a huge problem. For example, let's say, for example, if you see in any country due to certain problem, a bank crashes or bank goes down, then you will always see that, oh my God, in this country, the bank process, it's not a good country to invest. So global investors will not look from that perspective. So now there's financial stability has become a very key thing. And so all central banks put a lot of effort on financial finance. So you must have heard the concept of systemic important bank or globally systemic important bank. So they have identified that this type of bank or financial institution should not crash, because it sends lots of bad signals to the market. We have seen in 2008 that we thought that such a big banks cannot crash, but they have crashed. So now that's why financial stability becomes very important from that perspective. So that's the financial crisis basic definition. And when you talk about that, then we come to the COVID-19, and COVID-19 really led to curtailment of economic activity and to bring a severe recession, which we all know that. But what has happened in doing this? So when the economy was closing down and the uncertainty was enhancing, due to this, we have seen that people or the investors, the first reaction was that they always try to sell risky asset whenever there's uncertainty. Whenever there's an increase in the volatility, people will try to sell the risky asset because of uncertainty. And we have seen, and that's the time when you'll see there's a lot of selling pressure comes into the market. And in the bond market, it started from the corporate bond market, and which is the high yield corporate bonds, which is not an SLR, non-SLR in Indian market. Those people started selling. So when you sell bonds, what will happen? If you sell bond, the price of the bonds will come down and the yield of the bond will go up because of the inverse relationship. And when the yield goes up of the corporate bonds, so when you sold the money, so the money comes to you because you're an investor. What will you do? You'll not keep the money with you, but you'll try to move that money to a safer haven. So what are the safer haven? Then you'll try to buy government securities and so on and so forth. So you move towards that. And when you start buying government securities, the demand for government security goes up. And so the price will go up, the yield comes down. So then what will happen? The spreads between the corporate bond and the government security bonds enhances. And this bid and ask spread is one of the biggest indicator for all the central banks to see that why this bid and ask is enhancing. And if it is enhancing, that means there is some problem into that, because generally we see the spreads are not constant or changes little bit. But whenever there's a huge change in this bid and ask spreads, or whenever there's a change between the bid and ask of corporate yield as well as the government bonds, then we see that there is some sort of problem. So one of the indicators to see is that spreads. And once this thing started happening, you'll see there that goes to the equity market, because equity market, when they start selling the equity, global equity starts market goes down. And internationally, we have seen that also happen here during COVID-19, the equity market started crashing initially. So uncertainty about economic events can produce financial escalator effects through its effect on asset prices. So it will definitely, there's the negative multiplier effect starts coming into it in the asset prices, and all the asset prices start going down. So falling asset prices reduces. So then the problem comes for the bank that is here, is that once the asset prices goes down, the credit worthiness of the bank or the firm or the corporate, whoever was holding those assets, their valuation goes down, and the credit worthiness goes down. So you cannot keep those assets with the banks for taking loan because the valuation has gone down. So you cannot pledge those things, which happened in subprime also. We have seen that in 2008. So firms' credit worthiness goes down, and once the firm's credit worthiness goes down, the banks stop giving them the loan because they think it's a very risky thing to give them the loan. Where an NPA level will go up, so the lenders are reluctant to pay. So such a sudden reaction of credit or increase in the cost can disrupt the operation of financial system. Because if banks don't give the loans, then what will happen is the corporate and other non-banking entities will start defaulting. And if they start defaulting, then the financial stability again goes for a toss. So default will go up, NPAs will go up, and if there's a huge amount of NPA, then the bank's portfolio is getting hit. So even the commercial banks will also get hit from that perspective. So this is the chronology with central banks always try to see. It comes from a price volatility and leads to the disrupted financial activity. And if we don't keep a watch on the markets, then it becomes very difficult to forecast or to gauge the depth of the financial crisis which is coming in due course of time. So this is the point I wanted to make to all your students. See that always keep a watch on the price volatility of the asset, because that has got a very high correlation with the disruption of financial activity. Because if the volatilities are going up, if the bid-ask spread is going up, if somebody is from a financial market, you'll also see that there's something called credit default swaps, CDS, another indicator which you can see. If that is going up, that means chances of that people will be defaulting will be going up, and that leads to a disruption in financial activity. And that's why this becomes very important, that these are the indicators you should keep in mind when you're either identifying or trying to map a financial crisis, or try to forecast financial crisis, or try to minimize the financial crisis as a policymaker. So you have to keep a watch on these type of indicators. So what central bank did when they realized this COVID crisis came, the first thing which is very important from a central bank perspective is the policy rate cut. So everybody started working on the policy rate cut. Most of the central bank did this policy rate cut. So basically what happens, the central banks, so lower interest rate tend to rise asset prices, as I told, the inverse relationship, make the credit more affordable and increase the credit worthiness of the borrower. So this is theoretical knowledge of central banker, that if I reduce the interest rate, my asset price will go up. And if the asset price goes up, then the portfolio of the bankers who are invested, or corporate who have invested in this asset, their portfolio will go up because they will do mark to market, and the credit worthiness will go up. But in the real world, it didn't happen, or many times it doesn't happen. For two things. One, and one of the example which you always know, that Europe, and most of the time in 2008, after 2008, the interest rates were was on the lower side, was very low, especially in the Europe and all, which was almost negative. So obviously the cutting down of the interest didn't work much in favor. And second thing also, if you go to countries like African countries, or where the markets are not very developed, the term structure doesn't work so efficient. So if you do a price cut, let's say if you do a repo rate cut or a bank rate cut, and intention of the central bankers are that once I do reduce this, the other interest rates which are there available in the economy should also go down. But if there's no term structure, if there's no linkages of the interest rates of different tenures or different products, then this policy doesn't work. So it fails, or it will work with a lag, quite a bit of lag. So keep that in mind. Of the point which I'm trying to bring home here is that the success of policy rate cuts comes with a lag, or sometimes it doesn't happen also. So that's we need to keep into mind. And as I said, in Europe and other places where the interest rates were pretty low, cutting down the policy rates were not very successful. And as we have read, many big central bankers, they have always said that there's not much policy space for conventional tools like policy rate cuts and so. So this is the first thing. All central bank tried. None of the central banks increased the rates at this during COVID time. They have all tried this, but the impacts were, some places were successful, some places were not successful. So that was the first thing. So what are the other thing they have done? Obviously, majorly the big central bankers, they always did, and in the small central bankers also did that broad asset purchase program. So they started buying bonds, which I was talking about, open market operation. So if I can map the theoretical concept, when I talked about discount rate, and you can map the discount rate with the policy cut. Then I talked about open market operation, and you can map that with a broad asset purchase program. So what is it? Here, basically, asset purchases are out of lower yields, and the yields are on the lower side. So combination of local supply and duration and signaling effects, that's more important. I'll talk about the signaling effect. So they started buying bonds. So most of the central banks started buying bonds. And this is not in COVID. ECB, Fed, they have all done from 2008 onwards. They just started buying bonds so that inject liquidity into the system. And if their liquidity goes into the system, so the yields will be on the lower side, credit easiness can be on the higher side. But along with this, what they also did, they signal various things. What is one of the signaling effect is, central bank announces well in advance that I want to buy these are the bonds in next 3 months, next 6 months. That signaling effect also plays a major role in the banks, commercial banks portfolio or the investors, because the central bank will buy it. So obviously they'll try to accumulate those and to sell it to central banks. That sets a signaling effect, and automatically it will have an impact on the yield. So one is the actual purchase of the bond, and other one is the signaling effect, should be kept in mind, because whenever we look into this, we are not only trying to intervene in the market by today's market, but also we try to intervene in the market for the future. So one purchase and one press release of central bank can have two repercussions. So whatever central bank says, or whatever central bank governor says, there are a lot of things which comes out from the governor's speech, which generally people try to understand in a big way. A big governor's speech gives a lot of signals, and then the market acts on that perspective. So here in this case, the second tool was that they started buying a lot of bonds. So now when they start buying a lot of bonds, Vandita, I have time, right? Yeah.
Yes, of course.
Yeah. So when they start buying bonds, so what has happened in this case, that they started with the government securities. First layer of purchase was government securities. They started buying a lot of government securities and inject liquidity. But generally, the government bonds are purchased and kept by the banks. It doesn't have the real retail impacts. It does not have a non-banking impact. So what central banks, other central banks, this was the first one was started by Bank of Japan, and then followed by ECB, European Central Bank. They started buying not only the government bonds, but slowly other bonds. So they went to commercial paper, they started buying corporate bonds, they started buying exchange rate funds, they started buying real estate investors, REITs. Why? Because then the money supply injection can be directly to those corporates, non-banking entities, and even to some extent retail segments can be there, can be injected. So here the intention was not only to, because sometimes what happens, if I buy bond from a bank, the bank gets the money supply. The bank, if the manager or the owner of the bank is not very risk taker, he may not give that credit. And central bank many times cannot push the central bank, commercial banks to give credit. It can make the platform by reducing interest rate. It can signal things, but it cannot push in open market economy, like especially like US, UK, whether there's no, you cannot push, you can do moral suasion, but you cannot push the central commercial bank to give loan officially. So that's why it was basically then that said, if I inject the money only in commercial banks, and if they don't sell this thing or they don't give credit, then the policy doesn't work. So then that's why they extended the policy of purchasing bonds from government bonds to corporate bonds to exchange rates. So various instruments they started buying, except the equity. Equities didn't buy so much, but some of the central banks also went to that extent to buy equity. And when they buy this thing, what is happening, you should understand that when they buy this thing, the balance sheet of the central bank is getting getting bigger and bigger every day because they're buying it and then they'll be, when the things come, they will be selling it in due course of time. But now it was basically the broad asset purchase programs which was done. If you remember, I don't know how many of you must be following monetary policies of central banks very closely. Federal Reserve after 2008, they did a lot of purchase of government bonds, and then in around, I think it was 2000, and remember, I think it was 16, 17, they started announcing that they will be selling or the government bonds, which was there in their balance sheet. So they were just trying to reverse the position, and then the COVID came in, and again the bond asset purchase program continued. So this is the second tool which central bank used for purchasing, the bonds and injecting liquidity. So first was the rate cut, second was the broad asset purchase program. Then, even as I said, the broad asset programs were not very successful. So then they went directly of lending facilities, directly injecting into the segments which was badly impacted, especially segments like in RBI also did, Bank of Mauritius here also we did that, we given direct loans to SMEs, MSMEs, which was really hurt in that way. Even here in Mauritius, central bank went ahead along with the commercial bank to give loans to individuals also during the crisis period. So this was lending facilitated directly to the segments which has been impacted badly. So first was rate cut for everybody, buying purchase of corporate bonds, everybody, but this was much more micro impacts and going directly to the segmented and giving loans there, so that they have, so that they can be, they can get the credit and the business can start running again. One of the great example of which I wanted to share here is the Federal Reserve did this very efficiently. They created something called SPV, a special purpose vehicle, to purchase bank loans like from the commercial banks. So like 95% of each loan was taken, which was, let's say, for example, what Fed did was that they told all the commercial banks that you give loan to the SMEs and we will buy at 95% of each loan in our book. So what will happen in this case that you don't have the risk, central bank will take the risk, and which will also free the capital for giving more loans. So that was one of the way, injecting liquidity. So this is another way of, thinking of financial engineering for policy making, is that, okay, I'm not pushing you, but what I'm trying to say that you have the reach, because central banks cannot reach every nook and corner of the country. Commercial banks can do that. So you have the reach to go to the grassroots level. So you give the loan and we will buy that loan from you and keep it in our portfolio. So the commercial bank does not have the risk. Because if somebody defaults, the central banks will not get back the money. Obviously, since I'm buying the loan from you, the commercial banks will definitely get the money from the central bank. So this way it is something like a guaranteed or a support which was given by central bank to the commercial bank, that you go and give the loan and we'll support it. So that's the lending facilities structuring was done. There was various other structurings were also done, like ECB and Bank of Japan. They in fact, they given, because of the negative interest rates, they given money to or interest rate to the commercial bank to give loan to outsider. So different approach was taken by central banks to enhance credit during the crisis period. And why you want to enhance credit? The reason is that if you don't give credit, it will lead to financial instability, and that no country wants it. And one is financial instability, and secondly, definitely COVID has a human touch, because people become unemployed, people cannot eat food, so on and so forth. So definitely that is also required, and so nobody wants that to happen. So central banks were trying to do this. So first was repo rate cut, purchase of bond, and third was direct lending facilities to the segmented or industries which was impacted. fourth one was very interesting, was again, and this has started, is the international facilities. So as we know, central banks can always, they can always purchase assets indefinitely because they can print note. So if you can do that, but that is possible only with the local currencies. You can do that only inside the country. But if, let's say, if you're in, let's say, for example, in Mauritius, where I'm based, and if one of the commercial banks wants to give a loan to a corporate which is in USD, obviously Bank of Mauritius cannot print USD because it's a foreign currency. Now, what I can do is I can only do print in the lender of last resort domestic currency, which is Mauritian currency. But if I have to give USD loan, how do I do that? So what I can do, I can buy USD loan from the market, or I can raise bond in USD term from the global market. But during crisis period, nobody will lend it in the market. Nobody. Let's say whatever good, like for a Mauritius, it's a investment grade sovereign rating, but still nobody will lend it because it's a crisis period. So what happened in that case? The Fed decided, since USD is the major currencies in global trade, still it's a major currency in the global trade. They said, okay, we will do swap with the central banks. That is basically that they will give USD to particular, it will be from central bank to central bank through a swap or through a repo. And that will help the central banks to get USD in their portfolio, in the reserve managed, in the Forex reserve. And then through the Forex reserve, they can lend to at the bank rate or whatever rate to the commercial banks, and the commercial banks can lend to their corporates. So this international facilities really worked this time. It was there earlier also. Fed did it to the central bank to central bank. It also helped the Fed because it practically indirectly US economy by because improving condition of US trading partners and encouraging the international use of the USD. So it was a more political mileage also they get, because they can give. Still, US became more what do you call still more stronger international currencies in terms of trade compared to other central banks. And this time also they did one good thing, which was not done in 2008. In 2008 and all earlier, they used to do swaps. But this time what they did was they did a repo. So that means, let's say, for example, Bank of Mauritius, you have a Forex reserve, and in Forex reserve, you have in terms of currency as well as in terms of government securities. Now, foreign and gold, obviously. So each central banks have this reserves in this manner: currency, then the investment which is done in government securities of global central banks or global governments, and you have gold. So now what happens? So this is basic portfolio of any reserve management, Forex reserves. Then what this time it was done that if you want loan from Fed, so you can pledge or keep securities, government securities with them with a agreement that you will repurchase it back, and against that loan was given, USD loan was given by Fed. So this is another area which is basically injecting USD globally was done from central bank to central bank perspective. So this international facilities was one of the good one, which helped some of the countries from a Forex scarcity. Otherwise, generally you have seen that when there's a global crisis, you can have local currency, but many times there's a lot of restriction happens in the Forex side. People don't have money to even if they have a local currency to buy Forex, but the Forex is not available in those countries. So it creates a lot of problems. We have seen that many times in Africa and very underdeveloped countries. This Forex is shortages becomes real problem. So international facilities has helped a lot from central bank to central bank perspective. And this is another tool which has been used during COVID. And the last one, which from COVID policies perspective, is the regulatory changes. So central banks allowed a lot of freeway to commercial banks, saying that some of the debt restructurings were not taken into consideration. A lot of interest holidays were given, that you don't have to pay the interest today, but you can pay it after 6 months and whenever you get. So a lot of retail loans also gone, a lot of semi loans has also gone from that perspective. regulators, all countries allowed banks to defer recognition of credit losses, and there's another regulatory changes which happened. Uh, Fed brought reserve requirements, which is I was talking about, almost to zero. So you don't have, that's the biggest risk which the Fed has taken. But that was the way that injected liquidity they have done. So regulatory changes happen in central banks, like Reserve Bank of India also did that. They changed the CRR. They have changed the LC and liquidity coverage ratios quite a bit. They have also given interest rate holidays in India. So the regulatory challenges also, sorry, changes came into picture, and that is another tools which has helped or helping to revive the economy from that perspective. So just to summarize, different tools which has been used by central banks across the globe are rate cut, asset purchase, uh, then direct lending, international facilities, and regulatory changes. So just to summarize, as I said, India also did the same thing. I don't want to go into details because you people know better than me because you're sitting in India and reading every day this is happening. But point I'm trying to bring home here is that government of India did quite a bit of injection and did quite a bit of policy changes from a fiscal side. And as I was talking about, the nexus of monetary and fiscal policy was quite good, and not only India, across the world, to eradicate or to reduce the COVID crisis. So on the fiscal side, you see the India has government provided timely and large stimulus packages, largely focused towards two areas: funding immediate health responses and healthcare, and immediate direct financial support to the vulnerable households and business. So that was one of them. There's just to one point I want to raise here, because this intention of the government was very high, and they did a great job. But because my few next slides will come to this, is if the country like India, which is such a huge country, if they don't have financial inclusion, that means each and every people of India does not have banking facilities, such type of fiscal stimulus or becomes sometimes an unsuccessful policy because it does not reach to the grassroots level. And just mark my word, why I'm saying this, because I want to link this point with CBDC, which is coming in few slides. So that's the problem, because the government, the regulators, they can do, and they have gone out of the way to help the economy, but whether that is reaching to that grassroots level, that is important. Implementation is very important. And that is government and central bank, they'll try their level best, but if there are sometimes because of the crisis, you cannot do things which takes time, because the enhancement of financial inclusion takes time. It is a long-term policies that everybody should have account. Payment should reach there. The people sitting in Andaman Nicobar, or people sitting in Lakshadweep, and people sitting in various part of the world, the remote area also should get these facilities which government of India is giving. But to reach that, it takes some time. So that's one of the challenges which is there from government of big countries, where the financial inclusion is not very high. But I must say, when I'm saying not very high, I'm not saying it's low. It has enhanced drastically, but not reached at that level still, because the size of the country is so big. So one of the example, we have so many types of banks now in India. But thought of post office becoming one bank, bank which has been, that is one of the way to enhancing the financial inclusion, and that has happened quite a bit, because post office is there across the country, even in the remote villages and Bengals. So the government of India did quite a bit of good work, and they, from fiscal side, they did quite a bit of stimulus packages came into picture. Like India provided special economic package of INR 29.87 lakhs crore under Atmanirbhar Bharat. In the budget, also a lot of things were announced, and government announced relief package in June 2021 also. Same way, RBI continued their accommodative monetary policy stance since 2019. The repo rate was reduced by 100 basis point, more than 100 basis point, and it came down to around 4% by May 2020. And I think in the last 9 monetary policies, they have not yet changed that. They kept it 4% the repo rate, and the reverse repo at 3.3%. So that spread is also constant. They have kept it that way. Liquidity measures were included. Cash reserve issues were cut. As I said, CRR was cut, but again, I think it's been brought back to 4%. And the long-term and open market operations are there, which is being done in a big way. One of the way of long-term open market operation was of injection of liquidity. The second thing was also most of the central bank does open market operation to stabilize your currency. Because if you during current crisis period, there's a lot of tendency that the local currency may depreciate in a big time, and to manage the depreciation, central bank does a lot of open market operations. So this is a summary. In this presentation, I'll send it to Vandita if somebody wants to read it in after some time. But this is just a summary to show that whatever I talked about, most of the central banks have done that. So advanced economies and as well as the emerging economies, they have done the rate cut, and they have done asset purchases, they have done liquidity provisions and credit support, and they have done regulatory easing. So all this, what I talked about, most of them have done that. You can see why very less is in like Japan, because there's no point in doing rate cut when it's negative. And if you see the emerging market, advanced economies rate cut, which they have done, so blue color is the Jan 2020 and pandemic low, so it's seeing it's going down and down. And if you see the negative part comes for the Europeans, Japan area. So across the board, we have seen that the rate cut has happened. Now the question, another challenges comes is that, which is again central bank has to look into it, that once the crisis is trying to get over, the challenge is how to unwind these policies that user are so interest rate low, easy credit. How do I unwind? Because suddenly if I unwind it, then again the problem, let's say if you increase the interest rate suddenly, then what will happen? The banks, the commercial banks will increase the interest rate. The people who have taken loan, corporates and other places, their cash flows goes for a toss, and that again leads to financial instability. So you need to really bring balances in policies. You cannot abruptly change these policies. You need to give time on so then the next challenge comes is how do you unwind my policies? Because if I keep on my easy policy in a normal period, then what will happen? That expenditure, government expenditures and other things will go up like thing, and that will lead to huge amount of fiscal deficit, and that's have an implication that side, on the budget side. So you need to create unwinding policies slowly and steadily, seeing in the local phenomena and how the local economy is behaving. Because unwinding of policies will not be same as when the COVID situation came, most of the central bank came together and the policies were more or less on the same line. But unwinding will be depending on the local scenarios. So this is another challenge, that when to do that. So too rapid withdrawal of emergency support from financial institutions could destabilize credit flows and market share. Financial inclusion has to be enhanced slowly so that we can unwind and things can go into that perspective. Lag effects of policies are there, because sometimes you have just got the loan when the interest rate cut was done earlier, and suddenly you can again change that. So that will have an impact. So unwinding of policies is one important thing which is need to be seen, and take. You need to work as a central banker. You need to work from that perspective. So it's not easy unwinding of the position, because as I said, if you follow Fed policies, Federal Reserve policies, 2008 policies, which was then they were trying to unwind it in terms of 2016-17, but again in 2019 the COVID came into picture. So unwinding is a difficult task. Generally, the questions are asked in central banks will be definitely have to answer that inflation is going up across the globe slowly. So how do you manage that? So obviously they have to manage the inflation if the inflation is a monetary phenomena. But some of the countries believe that inflation is a fiscal phenomena, especially like import economies, island economies like Mauritius and all. it can be definitely a fiscal phenomena because supply constraints can come. So you need to be very careful to see that if the inflation should not go out of the hand, and then at the same time you should also keep the financial stability in the picture. So you have to bring balance between these two from unwinding policies. So that gives me a few more minutes to talk about CBDC, and I will try to link it with the monetary policy. It's a huge, important subject, which is the central bank digital currency. Since this session was more focusing on the monetary policy, this part is taking a little lower weightage in this presentation. But I would be very happy to speak on CBDC anytime in the future if you want, and a detailed CBDC just on the central bank digital currency. So as you all know, that digital currency is nothing but currency which is in a digital form, and you have a private digital currency and you have a central bank digital currency. Private digital currencies are the crypto. So we have a full gamut of crypto assets, cryptocurrencies. And cryptocurrencies, if I can go to this subject in detail, it's a very interesting subject, and I know many of the young guys are into it. They must be investing in cryptos in India. But obviously, when you invest, be a little careful on investing because it's a highly volatile asset. But just to talk to you on this crypto side, it came from a very basic concept that we need to decentralize the financial system, because now what is the concept is it's a centralized financial system that somebody is sitting at the peak, central bank, then commercial banks and commercial bank giving loans. So if I can decentralize this, then it becomes much more easier. And this concept came from that perspective that we don't want to go, and that's why the concept of blockchain technology came into picture. And the blockchain technology is basically where each and every entity of the block of the technology platform is verifying the other ones, all the transactions and all the whatever the function they are doing. This blockchain can be used for various functions. It is not only for payment, or it's not only, even it can be used for, blockchain can be used for keeping documents, standard, you have something called smart contracts and other things. So it can be, this platform can be, or this technology can be used for various things. But the concept of why I'm saying this in very quickly, because this subject is very vast subject, but I'm just trying to touch upon this, is basically is that when you enhance the block, or when you verify the certain function which is going into the blockchain, and it enhances the chain, and so chain connectivity enhances. When you verify this, somebody is verifying this, why he should verify it at free of cost? So that time it was introduced in Japan, saying that if you verify this transaction with some mathematical programming, you will get something in return. And what is that return? They said you will get something, a digital currency called Bitcoin. And that was the birth of cryptocurrency came. So cryptocurrency came basically as a currency which will be used in the blockchain platform. But it has taken a different shape now. There are now almost 15,000 coins which is get traded on the market. Now it's a private cryptocurrencies which are high volatility. And let's say, for example, if Bitcoin, if we all decide in an economy that we'll be making payment or receiving Bitcoin, and then the Bitcoin or cryptocurrencies can become, or private cryptocurrencies can become sovereign currency. And then what will happen in this case is that if the central bank does not have any control on these cryptocurrencies, then it will not have any control on interest rate. It will not have any control on monetary policy, because everything is handled by private cryptos. And when I say private cryptos, there's an official term which has been coined now, private money. Earlier days, we didn't have any private money or central bank money. Everything was central bank money, because money, or the which is the liability of the central bank, sits on the liability side of the balance sheet of the central bank, are the only money which is available in the geographical jurisdiction of that country. But now if the private crypto coming, that can also be taken as a money, and it can do payment and system. Now, that is the biggest threat which came to the central banks, saying that if this comes in a big way and everybody start accepting it for payment and payment function and the store of value function, then definitely then there'll be huge risk for the sovereign currency. And if that is the case, then our sovereign currency nobody will accept it. For example, if in India, if Bitcoin becomes a well accepted currency, then nobody will accept INR. And then the Reserve Bank of India will have no control on neither on the monetary system nor on the financial industry. And all this which we talked about is using interest rate, increasing interest rate, the monetary policy will collapse because you don't have any control on that. So to overcome this thing, the central bank started thinking that why can't we come out with a digital currency, which is called central bank digital currency. The difference is this is issued by central bank, so it will set into the liability side of the balance sheet of the central bank, and it is backed by central bank. It's less riskier compared to private cryptocurrencies, and this can be used for payments function within this jurisdiction, and it will be in digital in nature. And that's the reason why the CBDC came into picture. So in simple terms, CBDC is a short of digital currency, an electronic form of central bank money that citizen can use to make digital payments and store of value. CBDC offers three main elements. So it's a digital currency issued by central bank and universally accessible. So obviously this is through technology, it can be. If country issues a CBDC, this government will consider it to be a legal tender, just like fiat currencies. Both CBDC and physical cash would legally acknowledge as a form of payment and act as a claim on the central bank or government. So the risk came from that side, and because of that risk, the CBDC was born. So just think that the journey of cryptocurrencies. First, the blockchain came to make the payment in the blockchain system. Cryptocurrencies came, and then that is Bitcoin came, and after Bitcoin came, there many other coins came into existence, and then now the central bank digital currencies are coming. Now the debate which is globally going on, and my personal belief is, that's my personal belief, not I put your disclaimer on this, that's my personal belief, that you cannot ban private cryptocurrencies. Private cryptocurrencies will be there. If you ban in one jurisdiction, it will go to some other. It will become like an offshore account or offshore tax haven. So what can be done is that the central banks can come out with CBDCs, which should be used as a payment function. And it can also be used as an alternative asset. Like we buy dollar, you can buy the CBDC in terms of dollar. If you want to buy euro, now ECB is trying to come out with the euro, which will be CBDC. So that can happen. At the same time, the private cryptocurrencies can be there, which may not be allowed for payment purposes, but it can definitely be used for alternative assets. So because these assets can be definitely part of a portfolio to enhance the return, because you have if you cannot get the return which you're getting equity market, if you're not getting bond market, definitely you can get in the crypto market. So my prescription always is that you should not ban any cryptos. Let the cryptos be traded, but properly regularize, prepare regulations for this crypto assets market. But that may not be allowed for payment, but you have CBDCs which will be allowed for payment as well as for trading, and that then let the world do the market enhancement from that. Because if you ban cryptos, then definitely, let's say if you ban it in India, it will come to Mauritius, or it will go to Seychelles, or it will go some other countries where cryptos are allowed to trade, and the people on those countries will come and trade on this. So that will happen. That's happening in China itself. So most of the trading are happening in Hong Kong because China has banned cryptos, and they have come with their own CBDC. So banning may not be the right thing, but that's, again, I said that's my prescriptions are not of any central bank prescription.
Chirag, the students have some questions also.
Okay.
So if how much time would you need? Because 2 o'clock, I guess they have a session, so we can we can wind up in 5 minutes.
Yeah, 5 minutes. And
5 minutes, and then we
yes,
can take some questions.
definitely. I'll
Yeah,
talk in
thank
5
you.
or less than 5.
Sure,
So that's
no
the
problem.
concept of CBDC, and so as you have seen, the usage of cash is going down, and so obviously we are seeing the debit cards or automatic credit card is going up. Cash, definitely we are not using so much of cash, and so e-cash, which is the CBDC, can be an important thing to work on. So CBDCs can play a major role in supporting a payment landscape, avoiding the risk of new forms of private money creation, which I said, this is the biggest threat of central bank at this part, supporting competition, efficiency, and innovations in payments, meeting future payments needs in digital economy, improving availability and usability of central bank money, and addressing consequences of declining cash, and as a building block for better cross-border payments. Another thing which can be very important of CBDC is that if we have a concept of digital banking, which is there now in most of the country, and digital banking can be opened with proper regulations, it's just a platform. And if you have a CBDC launched in your country or any country, then the financial inclusion can become much faster. And if that happens with CBDC, CBDC can be used as a monetary policy tools also, because if it's because CBDC goes when it's injected or sucked out of the system, depending as we do for money supply, it will happen in real time. And if it happens real time, another advantage of the blockchain or whatever system you use for digital currency, I'm not saying blockchain will be used for digital currency, because blockchain has a lot of negative impacts also, like on climate change and other things. But the point is that whatever system you use, it will be audited till the last mile. So a lot of data comes to you from whenever you use CBDC. So the research can be done in a much better way for the policy. So CBDC can be definitely be important. So I'm not going to technical part since we don't have much time. I'll just skip this. So this is you can see the map which is given by BIS, and you see across the world, most of the central banks have started working on CBDC. Some of the central banks already have the live CBDC, and some of the people have started thinking on it. In Mauritius, we are working on this. I'm personally involved in this project to some extent the central bank, and we may see central coming and Bank of Mauritius coming with the CBDC by next year. So even RBI is thinking on that. So this is an in thing now. You cannot move away from CBDC, and it will be there. So this is okay. So first, the advantage of CBDC, just to summarize my session, it will reduce policy lag. Definitely it is, because it is an electronic version. It will be much faster. You can take the data on a quickly. So it will reduce policy lag, which was one of the disadvantage of the traditional monetary policy. It will use a usage of machine learning will come to research, because when you have CBDCs, will get n number of data. And when I say data, I'm talking about big data. And there's a concept of big data, which can be utilized for monetary policy research by central banks. So you'll see quite a bit of people in central bank which will get recruited who understand MI and deep learning and other things. Real-time payment systems, it will definitely enhance the real-time payment system, and reduction of anti-money laundering, because if CBDC comes into picture, it will also be part of the cross-border transactions, and if this cross-border transactions can be mapped to the last mile, so obviously the functioning of or the anti-money laundering or the money laundering can be reduced. But there's a point here: if through private cryptocurrency, there's a lot of money laundering happens, but through CBDCs it can be reduced because it will be under the central bank. So reduction of anti-money laundering will be a main thing, which many of the central banks are working on it. But CBDC can give an answer to that. So just to finalize my last slide on this, obviously these are good things of CBDC, but it has got risk. And one of the biggest risks is the cyber risk. So you need to have a very well-defined technology and a very high, good cyber risk framework for the risk management. A data risk, because since CBDCs will give a lot of information, so usage of CBDCs from central banks perspective, so it should not be hacked. So data risk is also another important thing which needs to be minimized. Latency issues can be there if the internet has a problem, and it's a big country, and then can be a latency issue. And the final one, which is most crucial for me, is the lack of knowledge. Because I've seen that people are highly educated, but the digital literacy is pretty low. So that can hamper the usage of CBDCs to some extent, or any digital currency or digital payment from that perspective. So lack of knowledge is low. And I think, and why I wanted to bring this point here is that this, the academic world, like or the institute like yours, can definitely play a role in enhancing this knowledge of usage of digital payment, how the digital payments are done, what are the risks involved into it, what are the products, and so on and so forth. So this needs to be done. So with that, I just finish my session, and I wait for the question answers. Thank you so much.
Thank you so much. I think we'll take about 10 minutes for questions. Shantam, is that all right?
Yes, ma'am. That should be fine.
Yes.
So, sir, we just have a few questions from the students. I would like Raghav to unmute himself and ask a question.
Good afternoon, sir.
Yeah.
Should core inflation be nominal anchor of monetary policy, as RBI targets consumer price inflation, which is dominated by food prices that do not respond necessarily to monetary policy? So should it shift its nominal anchor to core inflation?
See, this is, as you rightly said, it is purely a policy decision from an inflation target perspective. So it depends on which is giving more coverage from that. So if RBI believes that CPI is giving more coverage from that perspective, so they'll stick to it. This is, I think, a lot of people have talked about it, but still RBI is sticking to it. So I believe they have more belief in that, and that's why they're sticking to it. But inflation targeting is another area which is definitely, it has to be seen more carefully, because most of the policies depends on inflation targeting. And when I talked about the unwinding of the policy, that also helps a lot, because that is one of the indicators which will help you to unwind your policies in the post-crisis period. So I think that's a good question which you have asked, Raghav.
All right. Next up, we have Balia Rajan Singh. You can unmute yourself.
Yeah, actually, sir, I want to ask how will the emergence of the central bank digital currency is going to impact the monetary policy, and how will the conduct of the monetary policy become more challenging?
Precisely. I was trying to touch upon quickly. I didn't get because see, the monetary policy will definitely, if you're using now, the CBDCs can be designed in two ways. One is a free CBDC, like a cash, where there's no like, if you keep the cash in form of deposit, then only you get interest. Otherwise, cash doesn't have any interest in itself. So CBDCs can be that way, or CBDC can be used as a smallest rate. So let's say, on the yield curve, you have the lowest segment is 1-day repo. If you use CBDC below that, and that can be a monetary policy tool targeting. So like many of the central banks, even in RBI, they focus on 91 treasury bills as one of the target interest rates and the repo rate. So you can use CBDC if you're giving an interest on that. That again, I say, depends on the designing of the CBDC by the central bank. Then that rate can be a monetary policy target rate using CBDC rate. Second thing, it enhances, as I said, there'll be lag will be low, because it's a real-time effect. So as soon as you enhance or reduce CBDC, supplies will hit the portfolios of people or the bank. So it will be on a real-time basis. So the lag will be low. And if the lag is low, you know the impact of the policy quickly. Third thing, as you do this, you capture a lot of data, because let's, for example, if you're using CBDC to design, blockchain is in the platform. So you'll get a lot of information which will come to you, and your monetary policy research will be much more enhanced. Because now when you do a monetary policy research, you depends on weekly data or a monthly data or a quarterly data. In this, you'll have a real-time daily data, or which will enhance quick time. And that's why I was talking about the MI, the machine learning will become a very important thing in monetary policy research. So that again enhances the monetary policies function. So these are the three advantages of the monetary policies which you'll have. So I think that way we can enhance the monetary policy. You had second part of the question also. I'm sorry, Mr. Out.
I think the challenges, does it create any challenges for monetary policy was the second part.
Exactly. The challenges which I talked about, if you don't have a CBDC, then definitely it's a challenge because, for example, I know many of the private cryptocurrency owners, they want to capture various countries, small countries, and launch their crypto as a sovereign currency. Then the local currency will be eradicated from that. So same thing can happen in the big countries also. Let's say, for example, if Bitcoin is accepted by everybody or any other currencies is accepted by everybody, then obviously the sovereign currency will go for a toss. And that's the biggest challenge. And that's why all central banks are rushing for CBDC now. So because private cryptocurrency has become an in thing. You cannot remove cryptocurrencies. So that's the reason. And this is the biggest challenge for. So if your local currency is not accepted by people, then obviously the monetary policy loses all its significance. That's the biggest challenge.
Okay, sir, got it.
Okay, next up we have Priyam. Priyam, you can unmute yourself.
Yeah, thank you, Shantan. So, sir, as we know, RBI is planning to launch its own digital rupee, and we can also see that ATMs and physical bank branches are slowly reducing in the country, and neo-banking banks are also showing up. So, my question is, in a country like India, how likely is it that the people with traditional mindset will be able to adopt such a huge change? And what measures should the government undertake to encourage such a change among the people?
True. That's a very valid thing. And that's why my last bullet was lack of knowledge. You have pressed the right pulse because my fear is that because that if you don't have proper knowledge of using this type of technology, then obviously it will not be a successful thing. Before I come, what government should do, but one good part of India is India still have a highest amount of young population. And this young population, not only in main cities, but even in the remote villages, they are very well equipped with mobile technology. And CBDC can be introduced through mobile technology. And if you can, and as we know, I don't have to teach you, but you people are all young people, more and more days are going and mobile is becoming more user friendly. So with the high young population and easier mobile technology, these things will become much easier. But the problem comes with people, old people like us, or people who are senior citizens and other things who are not from this era of technology eras. There the problem comes into picture, and that's why sometimes it becomes very difficult for usage of such techniques. So what government or central bank or any financial institution should do, like what they have done for developing financial market, they should have a fund, which that fund should be used for training and awareness, enhancement of awareness through that fund. And they should do door-to-door campaigning, they should do training, they should do workshops, they should use it in Bollywood movies and other things which the Reserve Bank is trying to do through advertisement and all. That will help a lot to enhance the knowledge of the people. And if that can be done, then definitely I think this will be a success story. But I'm not bothered about the young generation, because India can take it up very quickly because it has got a huge amount of young generation. And we have seen that happening because pre-COVID, digitalization was not in thing. People was thinking that we should whether should do digitalization or not. But COVID has taught us, and everybody is very comfortable now working from home. Like you're working from learning from home. So I think that COVID has taught us that digitalization can be done quickly. That will definitely change the scenarios. So whatever we do, my view is that you cannot keep CBDCs out of the way. It will be there. It will be coming.
Thank you, sir.
So this would be the last question. Rachit, you may unmute yourself.
Yes, I'm audible.
Yes, yeah.
Yeah. Hello, sir. So my question is that it's more of a follow-up question. So there is a probability that a strong CBDC issued by a dominant global power, could end up substituting a weaker country's currency. Like if we consider the example of US, like the governance, it has an umbrella of so many countries. So what in that case is that a credible threat and how it can be tackled?
Yes, yes. So, this is it's a brilliant question which you have asked, Rachit, and but I would take this question to a concept of dollarization. Country like Zimbabwe, there are many countries where they have accepted the dollar as their local currency, and their local currency has absolutely gone for a toss. So there are very small economies in various part of the world. They use dollar as their own currency. So dollarization concept is always there, and you have touched the right point. It can happen. And now, thing is that the way you have protected your own country from becoming dollar becoming the local currency, the same policies has to be worked for CBDCs also. So what will happen if you have a e-euro or e-dollar? You'll also have e-INR. So INR will be there, and you have as a central, and I'm using the word "you" means the central bank of that particular country has to have a regulation that dollar cannot be used as a payment in this jurisdiction. It can buy rupee. That's it. And then this type of regulation has to be there. Otherwise, your question is very valid that there can be a strong CBDC issued by USA or China or any major country, maybe India also, because India is a major power and it can capture other countries also from that perspective, economic power. So it is the responsibility of the local regulator to prepare a regulation in such a way that it does not allow dollarization or enhancing of global CBDC to become the local currency. But this threat is there, no doubt about it. It's a very good question.
Thank you, sir.
So is it possible? We actually have quite many people with questions. Is it possible we can send you a mail with the questions and you can send it us anytime later?
No problem. Please do.
Okay, perfect.
Or what I can do is in the interview, I can take up those questions. I have
Perfect.
an interview scheduled later.
Huh,
Maybe I
that's
can integrate some of those. I'm not sure how many, but yeah, some of those.
perfect. Sure. I'd like Nikita to come over.
Yeah, so sir, we want to thank you for this enlightening and enriching session. We are sure that the students would have learned a lot from this interaction, and your valuable insights have helped us develop our perspective on modern monetary policy and digital currencies. We are grateful to you, sir, for your time and efforts you put in towards SIBM Bengaluru's leadership series, and look forward to hosting you again. Thank you, sir.
Thank you very much for inviting me. Thanks a lot.
Thank you so
It was
much. It
our
was
pleasure.
wonderful. It's good to see you after so long.
Yeah.
25 years.
Long time. Yeah, absolutely. So
Yeah.
I should leave this.
Yeah,
and
yes,
then join again?
Chiragra, yeah. So even we all will be leaving this. Team, you can stop the recording, I think. And then we need the